Hello everybody and a big warm welcome. This is Breaking the Mould, our regular market review with Russ Mould, our Research Investment Director. Russ, what's the fuss this week?
The fuss, it's all about the US Federal Reserve. Now I know Christmas is coming, the goose is getting fat, but from a financial market perspective, the 23rd of December is a really big day. It's actually the 100th anniversary of the creation of America's central bank. Now whether everybody's going to celebrate or not, will all depend on Wednesday the 18th and what the outgoing chairman of the Fed, Ben Bernanke, has got to say about American monetary policy.
Okay, so I've got two questions for you about this. The first one, why is Bernanke leaving?
I wasn't given any choice, actually. He's done 2 4-year stints. He himself might think, actually, that's quite enough of that, thank you very much. But Barack Obama didn't actually give him a chance to be reappointed. And it looks as if Bernanke's deputy, the Fed vice chair, Janet Yellen, will be appointed to replace him. She's already done the Senate hearings and looks to be given a clean bill of health.
Okay, so the second question, a little bit tougher. What's he likely to be saying? Okay,
that is the $85 billion question. One thing he won't be saying is he won't be increasing American interest rates. They're going to stay at 0 to 0.25% for the next 18 to 24 months at the least. They've been anchored there for 5 years. There'll be no change. What the market's really interested in is will he reduce or taper that $85 billion a month quantitative easing program and start to try and ease back on the monetary stimulus that the Fed's been throwing at the economy. They've been buying bonds at this ferocious rate to keep interest rates low, try and get credit flowing, try and give the US economy a lift.
Okay, so is that plan working?
Kind of. I think it's fair to say. They've got 2 main targets, unemployment between 6.5% and 7%, and inflation up to 2%. Happening, but really quite slowly. And if you look at some of the statistics, inflation is now at its lowest level since 1961, except for the crisis, and unemployment is still really just dribbling down. So therefore, personally, I would be surprised if he did taper. I've been wrong before, by the way, but I would personally be surprised, particularly because the data remain mixed and they've still got this political chaos in Washington. Democrats and Republicans are at it cat and dog. You've still got the debt deadline coming up in January. They haven't decided whether it's going to be tax cuts or increases or spending cuts. And I think given that potential for discontent, I suspect Bernanke will try and keep smoothing things through. The markets won't like it if he does taper. You'll get the latest temper tantrum. And you are having a little bit of a market wobble as people are looking at, equity indices are going down as people are worrying about a reduction. And if he does nothing, then you might see another leg up, which is exactly what you got in September when he stood pat last time. Because if interest rates remain depressed, returns on cash remain depressed, then the money will have to go somewhere else. And people looking for a reasonable return on their savings could be looking to stocks and shares for capital gains and also income.
So there it is. It's that magic word, income.
Crops up every time.
Is that not at the top of everybody's Christmas list?
A lot of people's. Obviously momentum players will prefer a bit more sort of quick kill, but the ultimate get-rich-slow scheme is dividend accumulation and reinvestment. There's a couple of companies who've got a very good record of this, coming up with figures in the next couple of weeks. Whitbread, FTSE 100 firm, famous for its beer, doesn't actually do it anymore. It's a hotel and coffee company, effectively. Premier Inn and Costa are its 2 main brands, both very well known. The company's going to have interims on the 10th and an analyst meeting on the 12th. They'll be talking about their 2 long-term targets, which is increase the number of Premier Inn rooms by 45% to 70,000 by 2018, and over the same period, double Costa's sales to 2 billion quid. Now, over the last few years, these 2 brands in particular have underpinned a lot of growth. That's enabled the dividend to grow by around 60% to 57p, and consensus is looking for 10% increases in that precious distribution for the next 2 years. Now that still takes the dividend yield to only around 2%, but you look at all the academic research, it's not a flat dividend that yields 5 that's where the action's at. It's dividend growth that really drives long-term share prices.
Okay, so you mentioned that there were a couple of names. You've heard one. What's the other?
The other one's a much smaller company altogether, Zytronic. It's based in Newcastle, does touch screens that are very rugged, very tough, because of things like cash machines, vending machines. So they get a lot of hammer, all weathers, so they've got to be good. It's high-tech stuff, so there's high barriers to entry, good margins, and strong pricing power. They generally turn into cash flow, which generally turns into dividends, which turns into income, and Zytronic's got a very good record there. Its dividend has doubled roughly in the last 5 years. Now, again, there was a bit of a wobble with the share price a year ago, some delays in contracts, mix shift issues, but the shares have started to motor in the last couple of weeks. Again, the market's looking for an increase in the dividend for this year to around 9.5p. That equates to a 4% yield for an AIM stock. It's not bad.
Not bad at all. So is there anything else that we should be looking out for?
Yeah, no Christmas boozy lunches for me, I'm afraid to say. Far too much to do. We've got the Bank of England statement yesterday. We've got the autumn statement yesterday, the 5th. So people are going to think about what they're meaning, because the government is now talking about a better economy. The Bank of England is talking about a better economy. Maybe even trying to cool things down, which, given that things have been flat on their backside for 5 years, seems quite interesting. But nevertheless, therefore, look at some of these cyclical sectors, house builders, retailers. We've got some good numbers coming up there. Give us a feel for what the economy's doing. We've got Berkeley Group with the interims today, the 6th, and Lucky Old Bellway, trading statement on Friday the 13th. And then in the retail side, Super Group with interims on the 10th, and Mossbros with a trading statement on the 10th. So both good insights into the economy. See if they bring a little bit of Christmas cheer.
Wow, so that run up to Christmas is looking very busy.
Always very
indeed.
busy.
Very busy. Okay, so thanks for joining us. This has been Breaking the Mould. We'll be back with you in 2 weeks' time to bring you lots more information and we hope a little bit of Christmas cheer. Until then, goodbye.